Good morning and good afternoon. Welcome to this SGN webinar. Today we will be covering the offshore rig market and the development in rig valuations. With me I have Erland Bassoe, Chairman of Esgian, Hans Hagelberg, VP Rigs and Greenpack Rigs, and Hans Jakob Bassoe, one of our offshore rig analysts. We will be starting off looking at the past few years and fundamentals impacting the market. Then we will look closer at buyers and sellers in the rig asset market. And finally, we will discuss the current situation and the outlook for rig values for the next few years. Over to Hans Hagelberg.
In the period between 2005 and 2014, the offshore rig fleet has grown from some 600 rigs to slightly over 900 rigs by 2014, and that created an oversupply. Then, to make things worse, in early 2020, the COVID pandemic hit an already weak rig market, with rig utilizations going from 78% down to 64% in the short period between February and June, and with rigs on contract dropping from 460 down to 378. And as a result, rig values took a tumble to an all-time low, with many rigs only worth scrap, and that resulting in offshore drillers filing for Chapter 11. Can we have the next slide? So could the fossil fuel renewable gap mean that we're moving towards a brighter future for the offshore rig market? The energy transition is still in a growth phase, and is not ready to replace fossil fuels to take up the additional demand when the economies now start to grow again. Energy demand is expected to surpass pre-pandemic levels already by 2022 and grow beyond 100 million barrels per day by 2023. Oil price has been around $85 level, which is the strongest since October 2018. Shale is restructured, and there is now more production discipline. Creditors has become drilling contractor shareholders, and that will also provide more discipline in their offering. Since the peak of 2014, the competitive fleet has been reduced through scrapping and conversion, and it now stands at 587 rigs, which is roughly the size of the fleet in 2005. There is no additional new building, and that creates more clarity in the supply overhang. So next slide, please. SGN is following offshore rig values and presenting them through to the market through SGN Rig Values, which is a digital platform providing rig values 24/7. The values are updated twice weekly or otherwise as market events might demand. The basis for rig values, the rig values platform, is SGN Rig Analytics, which is covering the status of all rigs in the world fleet and is providing rig demand and rig forecasts. SGN also have a third product called Greenpack Rigs, which is covering individual CO2 emissions from the world's offshore rig fleet. So next slide. The methodology for establishing rig values, then we're looking at things starting with the macro level, the oil price, oil company spending, etc. Then we're looking at the rig market itself and the rig supply, size of the competitive fleet, utilization, fixtures, and of course, day rates. We have value references, and the most important is, of course, recent sales. However, that can be difficult in a market as today's, where very few asset sales have taken place. It's important to point out that the values are always determined by the willing buyer and willing seller principle, and the values does not include any values from any contract. So it's contract charter-free values. Then finally, there are technical aspects such as the rig design, operating areas. We're looking at the rig specification to identify value driving factors, etc. Next slide, please. Since the peak of the market in 2014, the value reduction has been catastrophic. Looking at modern rigs such as 7th-generation drill ships and premium jackups, they've lost about 75% of their value. The class of rigs that has fared the best is the harsh environment sector due to its operational limits, the supply, the limited supply has helped to keep rates at a higher level, but still values have dropped about 50%. Next slide, please. And with that, we will move on and talk about the buyers and the sellers. So Hans Jacob.
Thank you, Hans. So firstly, in the current market, we believe that the traditional large drillers are not the asset buyers, as revenue growth can be achieved within its current fleet. These companies, such as Valaris, Transocean, and Borr Drilling, already have a large fleet, and after years with low demand and utilization, these companies look to bring stacked rigs back into work and improve its fleet utilization rather than acquiring an additional rig. On the other end, we have drillers that have less inventory of idle rigs and higher fleet utilization. These drillers are likely to take on a rig or two in order to bid on new tenders and take advantage of the current increase in day rates. So the buyers can be categorized into three groups. We have strategic, opportunistic, and conversion or scrap. So the strategic buyers can pay more to acquire more modern rigs and typically finance the purchase against a long-term contract. Typical buyers, as mentioned earlier, are drillers with less idle rigs. So for instance, Saipem that bareboat chartered the Samsung Santorini, which have a purchase option, and Shelf Drilling, which acquired the Maersk Completer and renamed it Shelf Drilling Enterprise. Both rigs have been contracted. The Samsung Santorini will commence work with Eni in the US Gulf of Mexico, while the Shelf Drilling Enterprise was contracted to Chevron for work offshore Thailand. Other buyers can be companies that have some sort of government support, such as ADIS, which acquired 4 Noble jackups on contract with Saudi Aramco earlier this year. The second buyer, the opportunistic buyers, are industry players who look to take advantage of distressed assets in the market. These buyers have either their own cash or look to raise cash quickly and buy a rig with little to no leverage, and the transactions are generally completed fairly quickly. The buyer look to take advantage of the low steel values, which must be favored to public equity, and acquire rigs on a discount. And later, this can lead to growth opportunities through consolidations. Lastly, we've got the conversion scrap buyers who acquire rigs at low values to scrap values for recycling of steel or cost-efficient conversion for other purposes. Typically, rigs can be converted into mobile offshore production units but also non-traditional conversion happened, such as offshore wind installation and also landing platforms for rockets, like the two Valaris semi-subs acquired last year. For the scrap buyer, the steel prices drive the market rather than the oil price, and the buyers are not value drivers, rather set the floor for rig values. And the rigs acquired are, of course, permanently removed from the market. So moving on, we also looked at the three types of sellers, and we got the strategic, distressed, and the stranded sellers. For the strategic sales, these are sales done by drillers, and values can vary from high values to low or scrap values. These types typically take place when drillers look to right-size its fleet, such after an M&A transaction, or when the company wants to exit a non-core segment, such as when Transocean sold its jackups to Borr Drilling. Also, in times such as now, drillers could sell off rigs to generate cash to fund future activities. Lastly, drillers sell for strategic scrap or conversions, and these typically happen, as mentioned earlier, during the right sizing, or when it does not make economic sense to reactivate a cold stack rig. When we see modern units sold for scrap or conversion, such as, for instance, a 7th-gen drill ship, it tends to be because drillers look to reduce the supply of rigs rather than allow it to continue with a competitor. We also have distress sales, which happen when creditors take over the company and the prices are lower than the strategic sales, but of course higher than scrap sales. Creditors become the unwilling owner when debt requirements are not met, and therefore they look to exit quickly and cut the losses. The new owner will look to run processes to downsize and restructure companies and sell off assets. However, sometimes the creditors could be willing to give some sort of an optionality for higher asset pricing. For instance, a bareboat charter with a purchase option could be an option for the creditor. Finally, we got the stranded sales, which are new builds that are controlled by the yards. In the current market, many new builds have been cancelled, which then leaves the ownership to the yard. Like the creditors, the yards become the unwilling owner, but these yards do not want to cut the losses and sell for cheap values. Typically, the yards have some sort of governmental backing and cash available, and therefore can hold into the asset for a longer period of time to wait for a fair price. And often, while waiting for this fair price, yards often combine the stranded assets into hold-up pools. So then, looking at the buyers and sellers deal territory, we can see that there is a price expectation gap between the willing seller and the willing buyer. On certain transactions, such as scrap and conversion, the buyers and sellers are more or less aligned. And this is also the transaction type we've seen the most of in the past few years. Some transaction this year could be, for instance, the recent sale of the semi-sub Leo to BW Energy for FPU conversion, and also Pacific Mistral and Bora to GMS for scrap. Looking at other transaction types, we of course have the distressed or opportunistic, strategic, and stranded. And the price expectation gap between willing seller and willing buyer is much wider here. These are also transactions we have seen less of in the market. By looking at certain asset classes, we see that the gap is narrowing. For instance, with improving market fundamentals, we believe there could be opportunistic buyers who would chase premium jackup deals at distressed prices. Furthermore, the 7th-gen drill ship price gap is narrowing, as we've seen both opportunistic and strategic transactions. For instance, with Deep Valley Driller, which was acquired from Dolphin early this year. Also, to narrow the gap, companies acquire ships with purchase options. As mentioned earlier, Saipem has the purchase option on the Samsung Santorini, while on the harsh environment semi-sub, we saw yesterday that Dolphin will market the two semi-subs, Nordic Spring and Nordic Winter, and also secure the right to purchase them at a later stage. I will now move the presentation to Erland, who will talk more about offshore rig values in the current energy crisis.
Thank you, Hans. Move to the next slide. Yeah, I suppose most of you have seen the James Bond movie by now, and we know the outcome of that. I cannot guarantee what the outcome will be of the drilling industry, other than saying This is not the time to die for most rigs, though regrettably, it's time for some, and that's what we look at here. So it's been a tough market for many years. It's been a long downturn, and still about 30% of the rig supply is stacked. 18% of the stacked rigs are fairly modern between 2005 2009, while all of 42% are built before 2005. And of these 195 rigs, 84 of them have been stacked for a very long period, more than 3 years. And such a long stacking period and old age in combination often makes the reactivation cost prohibitive for making or for bringing the rigs back with some economic sense to it. So many strategic sellers choose to scrap rather than invest a large amount of money in oldish rigs and bring them back and really create more competition. So with that backdrop, we claim it's time to consider those which have no time to die versus those which do. And if you look further down on the page and look at the distribution of stacked rigs, you'll see that jackups have a large percentage of old rigs. Almost 50% of the fleet is pre-2005. Semi-submersibles are very similar. 1/3 of the fleet is old, while when it comes to drill ships, most of the fleet is quite new. One of the major factors for bringing rigs back into operations is what you need to do to satisfy the class and the special periodic survey which all rigs have to go through. And as you can see from the graph, a very large number of rigs have their SPS position expired, and hence it will be costly to bring them back. Next slide, please. So in Esgian, we have detailed databases and system to analyze every rig in the world, and we can go in on all levels to evaluate these rigs according to various criteria. Excuse me. And when we look at sort of the retirement picture, if we apply some criteria which are on the right side of the page, for jackups it would be pre-2005, it would be typically old designs, one-off designs, long stacking periods, no SPS. For semi-submersibles, typically before 2000, outside of the North Sea, i.e. not capable to go back to the North Sea, unfavored designs, long stacking period, expired SPS, and for drill ships, more or less the same, but age pre-2013, long stacking, and there we also look more carefully at the reactivation cost, because as drill ships have been stacked for a very long time, the reactivation cost can be substantial, often $100 million or more. Next, please. So looking at that analysis that you just saw, and taking into regards that we've already seen a huge number of drilling rigs being retired, and will continue to be retired based on that analysis into 22 and 23, with more than 36 rigs in 22 and 47 in 23. Although some rigs will come back, we forecast improved conditions, so stranded rigs will come back into the market. But nevertheless, supply will continue to shrink, and to remind you, we already think that the supply level is at almost pre-2005 levels, i.e. 15 years ago. So if you blend this with our our demand forecast, we have a 10-year demand forecast, but applying that demand forecast through 23 and mixing it with retirements, we see that the fleet utilization for all of the rig classes we look at move above the magical 80% level. The experience from the rig market is that as soon as you move into the 80% territory, you see day rates move. And as you move up through towards 100%, they can move quite dramatically. So we think that the forecast based on utilization is a good qualifier for estimating where values will move. And if you look bottom left, we estimate a modern drill ship today in SGN Rig Values to be about 200 million. Looking at utilization in 23 of say 90% plus with OPEX of 150,000 per day, we think day rates will move from the current 280, 300, marginally about 300 to 400. If you just pick a multiplication of 5, we see that the rig values of these rigs could double, more than double, towards 450 million, which is still under the original replacement level, which often was 600, 650. For the harsh environment semis, the more popular unit in this market, at least prior to the recovery of deepwater drill ships, SGN Rig Values think such a unit today is worth around 300. They already have pretty good utilization, but when that moves into the 90% territory, they have high operative cost, particularly in the North Sea. Day rates would move from the current 300, 325, even a bit more, to 400,000, 400,000 plus, and such units would easily be worth in the 400 million range. If you go back to, or if you go down to semi 6th gen, kind of a little bit of the sort of the forgotten type of rig between the shallow water jackups and the deep water drill ships. We think such a rig, even if in spite of being quite modern, is only worth 100 million based on being warm or in drilling condition. But as the utilization also is forecasted to increase for this segment of the market, with OPEX of 150k, we think day rates could move to say 250,000, maybe an inch higher than that, and quickly we see values develop into the sort of the $180 million range. So all of this point towards at least the platform, towards fairly substantial value appreciation over the years to come. But obviously there are risks to these values. As we know, it depends heavily on the oil price and hence the oil companies' earnings, because they need good earnings to pay for drilling. Being dependent on world economic growth, we are dependent on shale oil production and discipline within that field. And obviously, if OPEC Plus open the floodgates, yeah, something would happen to the oil prices. And we have other factors like Iran, Iraq, and so on, but not in the near term. And then we have another factor, which is today, in today's market, very important to take into consideration, and that is the climate risk. There is definitely climate risk in fossil activities, and it will cost money to reduce emissions from drilling rigs. And these are factors that has to be looked at going forward to, say, fine-tune value potentials. Other risks could, of course, also be as demand of oil and gas as we move into renewables. But also we see that there are some funding challenges for oil companies in fossils. It's not the most popular item to finance these days. If you want to look at the climate risk of rigs, we mentioned earlier that we have a product called green-packed rigs, which calculate emissions from all drilling rigs in the world. So now you have heard that the supply of rigs is close to 2005 levels, which is quite remarkable, I think. And still many rigs will be retired, as we have gone through. We know that demand for oil obviously is higher today than in 2005, and since 2014 there has been a very large underinvestment in drilling for oil and gas, less than half in what it used to be in 2014 last year. And renewables are immature and extended. So there is this fossil renewable gap where drilling comes into play, we think. And we think these conditions will lead to high utilization and high day rates, and ultimately increasing values for those drilling units with no time to die. Thank you very much.
Thank you, Erland. There's a lot of strong information and assessment of opportunities there for the drilling rig market. We do have a few minutes left and a few questions that have come through from the audience. So I'd just like to pose a couple of those questions to the three of you, if we can go through and try and answer those. So the first one was, how do rig values compare to implicit values of publicly listed drillers?
Yes, I mean, rig values, well, you need to kind of be in the market, constantly hearing about the bid asks, talking to people, so that's sort of a market function. Implicit values are just what you get from analyzing a company, its stock price, dividing the balance sheet, net effects of the balance sheet over the fleet, and develop and sort of divide between the various assets within what's the positive values are to find a value for each class of rig. So, for example, if you look at the various companies, SGN, if you look at, for example, Diamond, Rig, Valaris, Noble, Drillco, consider SGN implicit values, you come to, you know, a very large figure because of the depth in Transocean, so that's like 300. But for Valaris, Noble, and so on, it's about 165, 170, very close to the values that we have. And it can vary a lot, but you know, you have to run your own calculations. But usually when you see implicit values increase because the stock price increase because it's liquid, people look to buying steel rather than stock, if you can, if you're disposed to do that as an investor.
Okay. There's a couple of questions sort of around. I'm trying to put these into one. It's sort of rig values. You know, when do SGN expect to see increases the most and the soonest? Which areas?
I don't mind covering that.
Yeah.
Or yeah. So we think that the modern drill ship, so the 7th gen drill ship, will probably have the most and the soonest appreciation potential, because there's been a lot of demand and utilization has been quite high there recently, particularly in certain regions such as the US Gulf of Mexico and South America. We also believe that premium jackups could expect to see a significant increase. These rigs are, you know, operating in shallow water, and there are cheaper drilling costs when using jackups. So as the oil price continues to move, the recovery there of the value can happen quite rapidly. Lastly, I think the semi-subs, like we mentioned, it's kind of the forgotten asset, with the exception of the harsh environment, of course. And we don't see a rapid increase in values, at least not in the near term. But as the utilization increases for the drill ships and the drill ships become less available, certainly the deepwater semi-subs will be in higher demand and a more attractive asset.
And if I can add to that, we talked about the different type of sellers, and you know, there are different numbers of rigs available in each level. So if you look at the distressed segments, it's not an endless number of rigs for sale there, though those can be a bit cheaper than the more sort of strategic side or the stranded side. And as those segments of the market empty out and those rigs get sold, you kind of move up in the value chain from the cheapest units to the most expensive units, being probably the stranded units with Chinese, Korean, and Singapore shipyards, where you see, for example, a jackup having an asking price of, call it 80 million, versus if you look at the distressed levels, you're probably talking in the 30 to 40 million. So as you move through the value chain and the supply of the keener rigs empty out, you quickly move up to the next level.
Okay. I just time for one more, though we have got several, but this has been asked on a few different scenarios. We mentioned that the competitive fleet today has decreased to about 2005 levels, and that demand is expected to return to pre-pandemic levels. Do Esgian expect to see a recovery similar to what happened in 2005?
I would say no, of lots of different reasons. We don't foresee any really new building taking place. With the energy transition, the lead time will be such that it's going to be difficult to have paid down on a new building taking place. So what we could see that will take up the slack from the level we have today is when utilization or demand starts to increase, there is room to move stranded assets into the working fleet, as you could see earlier in the presentation. And a lot of the uncompetitive parts of the fleet, we have about 80 rigs today, which we consider uncompetitive. They will disappear, and also some of the more long-term stacked units. On the new building side, it's also worth to note that many of the shipyards that has previously been building offshore rigs has moved away and now engaged in shipbuilding, and it's unlikely that they will come back and start building rigs anytime soon. So while the competitive fleet will increase with stranded units and some stacked units, we don't see anywhere near as much added supply as you could see in the years leading up to 2014.
Okay, thank you for that. We're at the end of our allotted time. I know we have a few questions that haven't been answered, but we will reach out to those people individually and answer those questions for you over the next couple of days. I'd just like to say, a huge thank you to everyone for attending today's presentation. To confirm again, the recording will be posted onto the SGN YouTube website in the next couple of days, and we'll send a copy of the slide deck to all those people who attended today. And thank you very much to the three presenters for insightful information, and hopefully we all got some valuable takeaways from this. So thank you again, and this concludes today's presentation. Thank you, everyone.